Welcome everybody, this is Tom Long. On behalf of all of us here at Aura FX, I do thank you for joining us for this webinar. We're going to get a little technical here. We're going to be talking about top 10 technical indicators. We went out and asked all the traders on the face of the earth what their favorite 10 were, and we just didn't really do anything with it. I just picked them myself. So these are actually my top 10 favorite. But in actuality, having been in the business for a few decades, we see time and time again where traders use the same indicators over and over again. Some of them I think offer some real value, others very questionable, but we're going to talk about the pros and the cons of each, and I will share with you a couple of my favorite combinations. And as we talk about them, and then we're going to get into going to the charts and look at some live examples of some trades that are potentially setting up. Of course, they are not trading recommendations. This is for education only. But we're going to be using, we're going to check out the charts and look at some examples, some trades that are setting up using the indicators that we're going to be talking about here. The second slide here, which I hope shows up, is our risk disclaimer. And of course, I hope that over these last couple of days, we have really explained the importance of this, the fact that you can, and many people do, lose money by trading. I know, incredible concept, who would do that? But as a matter of fact, okay, let me confirm here. Let me stop. We've got nobody seeing slides. Is that correct? All right, let me try stopping this and let's try something different then. It was working? Okay. Okay, we should have the risk disclaimer on. Does everybody see that? Okay, very good. Thank you very much. So, and like I said, I hope we've impressed upon you the risk that is involved in in trading and speculation. This is really speculation in the markets, and of course, one of the keys is money management, and that can help change the odds into our favor, which is really what we want to do. Okay, but let's get into some indicators here. Now, the first important point I want to make is that a technical indicator should be about the last thing that we look at in our steps of identifying an entry into a trade, okay? Not the first thing, but the last thing. And we'll kind of get into what we're going to look at first here, and we kind of see an example here. First of all, we want to identify strong trending markets because indicators will work best in strong trending markets. And I believe that strong trending markets offer the best trading opportunities. So there are two great reasons to find strong trending markets, and we're going to get into that when we go to the charts. But first of all, this is what we look at. We look for the ABC patterns as we see markets that are stair-stepping their way up or stair-stepping their way down. And we're going to show plenty of examples here, so don't worry about this graphic here. But what we're trying to do later on when I talk about breakout trading, we're going to talk about buying as the market moves up through point B, but some traders like to get in before that point, okay? They like to get in closer to point C, and that is where the use of technical indicators can help us to better time that entry. But first we have to find the market that is trading the way we want it to trade, otherwise a chart that looks like that the market is trending strongly, and then only when we find that do we want to refer to an indicator to help us time our entry. Again, an indicator will only tell us where the market has been trading up until that point. The market itself will do a better job of that, okay? But a lot of these indicators will only note changing momentum, but changing momentum doesn't really mean a thing unless it's in its proper Otherwise we frame it correctly. We want a market that is either moving strongly to the upside, because we're going to look for that pullback, and then we're going to look for that market to move back to the upside for a buy, or we want to look for a market that is moving to the downside. And again, we want to look for that stair-step formation, and we're looking at point C, and we're using indicators to time our entry as close to that point C as possible, okay, instead of waiting for the breakout. Okay, this is what it looks like on a chart. This is a 4-hour chart of the euro. Yes, we will talk about time frames. This is a 4-hour, which is one of my favorite time frames, which is kind of unique because this is unique to the Forex market because, of course, the 24-hour nature of trading in the markets. The 4-hour charts are referred to as the dealer charts. Now, I do believe that there are still more traders trading on the daily chart, okay? But I also believe that most of us as individuals prefer to be a little bit more active in our trading. So the 4-hour chart gives us some excellent ways to identify trading opportunities in the market that come up a little bit more frequently than on the daily chart, but at the same time it doesn't move so much that we have to be following the market 24 hours a day in order to monitor our trades. So a 4-hour chart really is my favorite time frame to look at. And we can see here that the $0 is moving down, and I've got the ABC move showing here on this chart. Now what we're going to do is use this chart to go through and use all the technical indicators so we can kind of see the difference between them, and we can talk about some of the advantages and some of the disadvantage. But number one, we see a market that is trending strongly to the downside. We are only looking for selling opportunities in this environment. We are not trying to pick the bottom of the market because, as we've talked about over these last couple of days, there's no such thing as a market has gone down too far. It has to move up, or it's moved up too much. It has to come down. That just really is not reality. Markets can and will move a lot longer and trend a lot longer than people want to give it credit for. We want to take advantage of those strong trending markets, and particularly in the Forex markets, because they are known as the strongest trending markets. So we want to take advantage of that. We want to embrace that as one of our edges, because after all, successful traders do nothing more than identify a series of edges, and they keep exploiting them until they no longer prove to be profitable. Okay, so we've got our euro dollar moving to the downside. We can see that the move from B to C is a corrective move within the downtrend, our stair-step formation. Now, the first indicator we want to talk about, of course, are the most popular, and that is the simple and exponential moving averages. Now, a moving average really started after World War II because a lot of the people who were in the military in World War II were using this type of thing in a new technology at the time called radar. They were using moving averages. So after World War II, a lot of those people, as they came out of the military and came back and resumed their civilian life, used a lot of things they learned in the military, particularly in the financial markets, and one of them was how to smooth data. So moving averages really do nothing more than smooth the data. Otherwise, a 100-day simple moving average is computed by just adding the closes of the previous 100 days together and dividing by 100 and then plotting that number on the chart, and we do that on a daily basis. Okay, and then we just connect the dots and we can see a smoothing. It kind of gives us an idea of which way the market is moving without all the herky-jerky or the volatility of some short-term moves usually caused by news events. Now, an exponential moving average was for those traders who wanted to turn it up a notch, and instead of using the simple moving average, otherwise using the 100 days, the 100 closing prices, they added more weight to like the last 5 days on the assumption that more recent trading activity is more important to where the market is right now. Okay, but using one or the other, really, I used to get this question all the time. People would email me and say, Tom, which is better, simple moving average or exponential moving average? The answer is there is no way that one can be better for the other. They're different, but they really do the same thing. Need some proof? Let's use the blue line here is the 100-day simple moving average. The red line is the 100-day exponential moving average. There really is no difference between the two. You see, all of the trading takes place below the moving average. So this is use number one. I like to use, and this is the one I use, the 100 period. By the way, if it's on an intraday chart, a 4-hour, 1-hour chart, we call it the 100 period simple moving average. If it's on the daily chart, we'll call it the 100-day moving average. And you can see that all of the trading activity is taking place below the moving averages. The moving averages are moving down. The market is moving down. This is a strong downtrending market. And I know if you get into like the trading station too, as pointing out here, we have weighted moving averages, we have triple exponential, I mean, we have double dare moving averages. I mean, there's everything that traders have you know, just decided to create in order to just try to get an edge. But I'm here to tell you, the edge is not which moving average that you use. The edge is how you use that moving average. Otherwise, what we bring to the table is the edge in the trading, not what is available when we get there, okay? Now, I just used the 100 period simple moving average to help with the direction of the trend. It's not that I need it. Obviously, if I can look at this market, I can tell this market is in a downtrend. But if you're looking at multiple markets over a short period of time, it's nice to use some of these tools to help you see things a little bit clearer. And that's basically all this is. This is a way for me to quantify that the trend is down. If I'm looking at two markets, and one of them, the market is kind of piercing the moving average, and the other one is like this where it is not, then this is where I'm going to be looking more for my trading opportunities because it is in a stronger downtrend. I like to cherry pick downtrends. A moving average is an excellent tool to use that. Now, you'll find that the most popular technical indicator on the face of the earth in all financial markets all around the world is the 200-day simple moving average. That is usually the one that they even talk about on all financial programs, where the stock market moved up through the 200-day moving average and moved down through the 200-day moving average. And that's fine. I mean, I'm not saying that the 100 is better than the 200. That is just my personal preference. I like to make sure I'm trading stronger trends, so I use a smaller number for that. Now, I know that the 10-day exponential moving average was very, very popular for real short-term traders. It was put together in a book called Pit Bull by Marty Schwartz, a very successful futures trader out of New York. And he liked the 10-day exponential moving average he wrote about, so that became very, very popular. But really, I mean, it's just a matter of how you use it, not necessarily what you're using. And you can use any of the moving averages, but the fact is that the simple moving average is as good as any. And I think you'll find that I like to have access to some of these indicators on mobile devices, and it's kind of limited because we don't have flash on mobile devices. We're kind of limited as the indicators that we can get, where you'll find that the simple moving average is the one that is just about on all trading software that you can access through the mobile device. Now we have the average directional indicator, which is the ADX. And usually those come with, so we're getting another 2-for-1 here, which is the directional indicators, the minus and the plus. Now they represent a group of directional movement indicators that form a trading system developed by Wells Wilder. Okay, he is one of the fathers of technical indicators. You'll find this name coming up again and again. And the one thing I do want to point out, that these popular indicators, you'll note that they were developed like in the 50s, the 60s, and the 70s. Keep in mind that this was before computers. These guys were doing this by hand, which kind of tells you what kind of commitment they have. We talk about patience and discipline. I mean, this is a major test, trying to identify technical indicators at work and giving yourself enough historical data to kind of confirm that worthiness and having to actually do it by hand. It's very different when we just poke it up in our computer and we can go back and we can see the moving average from the Dow Jones Industrial Average going back to the 30s or whatever, for 100 years. But it's a little bit different when you're doing it by hand. But the ADX is kind of a momentum indicator, okay? It shows us the direction, or excuse me, it shows us the strength of a trend. It is the DI, the directional indicators, the plus and the minus, that show us the direction of that trend, okay? But a picture is worth 1,000 words. Here again is our same 4-hour chart. And you can see the yellow line here is the ADX. Now when this line is moving up and gaining in strength, that is usually an indication that the trend is strong, okay? When it's moving down, the trend is usually weakening. and then it starts to move up again, the trend is strengthening. Now we also have the DI plus and the directional index plus and the minus when they cross over. Otherwise, when the red line, which is the minus, is above the green line, which is the plus, that usually means that the market is moving down. Okay, we can do a much better job by just eyeballing this, but as a matter of fact, that ADX can be pretty popular and pretty effective for traders who just like to measure the momentum or strength of a trend. We want to make sure that ADX is moving up and is continuing to move up, and that means we've got a strong trend. Once it peaks, and of course we don't know about the peak until after the fact, but it doesn't take long to figure out that it is moving down, and that means that the trend is weakening. The downtrend, obviously this is our corrective move against the trend, and that means that, of course, that downtrend is extremely weak because there's enough buying pressure in here, usually short covering when in this situation. Otherwise, traders who were short had sold the market, and now they're buying back to close that hopefully profitable position, which of course causes the market to move up. So the ADX can be valuable to show the strength of a trend. But again, sometimes just eyeballing it and using the moving average can tell us the same information. Now, Bollinger Bands. Now here's another thing about some indicators. A lot of them were developed by traders who their goal is marketing. Otherwise, they're authors, they're money managers, and the best way to get your name out there, develop a new indicator, trademark it, and hopefully that all the charting packages pick it up. John Bollinger may be the example of one of the most successful by developing the Bollinger Bands, which of course at the same time it can be pretty effective too. I'm sure there are a few traders here who have looked at them, and they are very, very good. But they are basically, let me tell you another secret about most of these indicators. They're really all just fancy moving averages. I want you to think about that. When you go to calculate these, usually the first thing you start off with is a moving average, whether it's an oscillator, whether it's a Bollinger Band, whether it's the ADX. It really doesn't matter. They're really just fancy moving averages. But of course, they become more complex and they give us a little bit more information, which can be very, very effective. But as we said before, moving averages can only tell us where the market has been up until this point, which is the same thing all of these indicators. None of them will tell you where the market is going. None of them. Okay? And the sooner we let go of that, the sooner we can find that these indicators can be an effective tool, because basically that's all they are, is tools to help us identify our entries into a trade. Okay? But any tool is more valuable in the hands of a master than it is in the hands of an apprentice. And indicators are the same thing. I always recommend that people kind of gravitate toward a couple of them that seem to make sense to them and go ahead and use those. I used to get emails when people said, you know, I just don't see how MACD works. I don't get it. What should I do? I know you know what's coming because my response, you know, I tried not to be flippant about it, but I would say don't use the MACD. There are plenty of other options to use. Stochastics, which happens to be one of my favorites, would be a worthy substitute for the MACD, but we'll get into that. Let's talk about the Bollinger Bands here. Now again, here's our ABC pattern. Now, the one nice thing about Bollinger Bands is it includes a volatility filter. When these bands start expanding, that means the volatility is picked up, and we can see that right here. Probably caused by, well, it looks like it was the beginning of September, so I'm guessing this is the non-farm payroll number, the first Friday of each month. But you can see beforehand, valuable information, how close those bands are. That means the market is ready to break out. Now, technically, this is a very, very effective way to identify markets which are really ready to break out, okay, is when these bands get close together. And you can see the market did break out strongly to the downside, and then the bands are, the difference is expanded, which means that the market is picking up. Now, what I want to zone in on here, you can see how the market has moved up to touch the upper band at point A, and then moved down through the lower band. That is where a lot of traders who use Bollinger Bands will sell, okay? And they will continue to stay in the trade until the market either moves up to this middle line. Now this middle line is a 20-period moving average, okay? Here we go again. Or maybe back up to the upper band. But you can see the same thing happened here. And the market moved up and touched the upper band. And of course, what's key here it's not key. It's more than key. It's just about everything is the fact that the market is in a downtrend and we're only looking for selling opportunities, confirmed by the fact that the market is trading below our 100-period simple moving average. But the market moves up to the upper band, and again, we can see it start to tighten up, which means it's ready for a breakout. It blows through the lower band, and you can see that this trade, if a traders who are waiting for it to move back up to the upper band, or using the simple 1-to-2 risk-reward ratio, which we recommend for newer traders, you can see where this offered a couple of solid trading opportunities for traders who have used Bollinger Bands, are comfortable with it, and know how to use it effectively to make sure that they have the edge and they embrace the edge. Okay, but again, strong trending market, only looking for trades in the direction of the trend. That's what really sets up the effectiveness of these indicators, and this is a very, very good example. Okay, the MACD, known as the MACD, the Mickey D, whatever you want to call it. This was developed by George Apple in the late 70s, another gentleman who's developed quite a few indicators. The moving average convergence divergence oscillator is one of the simplest and most effective momentum indicators available. But basically what it is here we go again with the moving averages, is you're taking two moving averages. The default setting is a 12-period moving average and a 26-period moving average. But instead of plotting both of those on the chart, we're going to plot the difference. Otherwise, we subtract one from the other, and that's the line that we're going to plot on our chart. So basically, as the market is expanding, otherwise the trend is getting stronger, those moving averages will expand, move away. Those lines will move away from each other, and that's when the MACD is moving up. When the market is kind of moving sideways, the MACD will move down because the moving averages will move in closer together. Now the second line on the MACD is nothing but a 9-period moving average of the MACD itself. Okay, so just layers of moving average, one after another. Now I find that again, here we go with the same 4-hour chart of the euro dollar, and we're looking for a way to take advantage of this counter trend move against the trend. And you can see is what you're looking for. And typically what I like is looking for a crossover above the zero line, okay? And when I'm looking for a selling opportunity, if you're looking for a buying opportunity and you want to cross over below the zero line, okay? And of course this is the zero line here. Now I find that the MACD is pretty slow, so it is usually the last indicator to show the entry into the trade. So its effectiveness in this way can be somewhat limited, but it still does offer some value. Okay, but again, it's just another tool that we can use for some traders. They like that. You know, being first, you know, doesn't necessarily mean being right. You know what they used to say, the pioneers of the West are the ones that had the arrows in their chest. Okay, being first is not always better. Sometimes being in the middle of the pack or being in the end can be better because you're waiting for confirmation that that trend is intact and that market is ready to move back down to the downside. The RSI, another one by Wells Wilder, the Relative Strength Index. Now this is an oscillator that shows up on your chart between values of 0 and 100. Overbought is usually when the RSI is above 70, and oversold is usually when the market is below 30. Now the concept of overbought and oversold can be a little bit tricky. And how do we measure that? By simply using these indicators. That's what oversold and overbought means. Traders or analysts are just using an indicator to show that. There really is no such thing as overbought or oversold. Usually when a market is overbought, you'll find that those are the strong trending markets, and you're better off buying a market that's overbought because there is so much buying interest that the market continues to move up. And the same thing on oversold. A lot of times we're better off just selling a market when it's oversold because all the selling interest in the market. We talked a little bit yesterday about more professional traders will buy high and sell higher rather than buy low and sell high. Okay, think about that a second. They're buying and selling the breakouts. But here's an example of the ABC. We can see that the market again is in a downtrend, the same situation, and we can see where the RSI dipped up, or not dipped, but moved up above 70, thereby showing us a market that is overbought in a downtrend. Now we've got a powerful combination. Okay, oversold in a downtrend really just confirms the downtrend, right? If you follow me. But overbought in a downtrend means that we've got a market that is moving against the direction of the trend, and hopefully the trend reasserts itself and the market reverses and moves back down to the downside. Okay, so we can see two examples here. Number one in our ABC, it was a little bit early, and we have another example here at the end of the chart. We can see where the market moved up above the 70 while the market was in a downtrend, thereby offering another potential selling opportunity using the RSI as a timing and as an entry, help us time our entry. And again, what you do when you get into the trade really is what trading all about, and that's why we talk about using that simple 1-to-2 risk-reward ratio to put the numbers on your side. And professional traders will work the trade. Otherwise, they will try to stay in the trend as long as possible. But that does take a little bit of experience. And so we recommend in the beginning use the 1-to-2 risk-reward ratio until you feel you're ready to move up to the next level of working a trade. The stochastic oscillator from George C. Lane in the late 50s. And George C. Lane, this is one of my favorites. Now, most of these, I should say all of them actually, really started off in the futures markets, which is kind of strange. George C. Lane was from downstate Illinois, just a farming. He was a farmer, and they were trading wheat and soybeans and corn, and he developed this indicator to kind of help him identify when the markets were moving in periods of strength up or down. Okay, now this happens to be one of my favorites, and I say that, and I want to qualify that by saying that doesn't mean that you should be all over this one. Okay, I want to talk about the fact, and I can consistently talk about the fact it's the one that makes sense to you. It's the one that just jumps off the page to you and says, buy me, sell me. That's the one that you should be using. And we really don't need more than one or two different indicators to help us with our entry. The more you use, the better chance of the thing falling apart and really not working for you. But we've got our ABC again, and you can see the stochastics. Now, I don't know if you can see that, but I'm using a value of 14, 3, and 3 for stochastics. A lot of times on the Forex charts, you'll see a default setting of 5, 3, and 3, which I really don't understand. I come from a future market background, and I know that the stock charts and future charts usually have a default setting of 14, 3, and 3, and I like that much better. I like to slow it down. I'll take less signals if I think I'm getting more accurate signals, and I consider that a good trade itself. Okay, just give me half the trades, but if they're stronger trades, I'll take them. Okay, but we can see a couple of examples here of trades. One of them back here, where we can see the market moved up above and then moved down below 80. Now, unlike the RSI, where the overbought was above 70 and oversold was below 30, on stochastics, it's 80-20. It's the overbought is above 80 and oversold is below 20. And you can see how long this indicator stayed in oversold area. And for traders who really don't pay attention to the trend, they are buying every time this market moves up above, and they're wondering why the stochastics really is worthless. It's because they first didn't identify the direction of the trend, they first didn't take advantage of the strong trending markets, and then in the end used the indicator to help them time their entry. That is really important to understand that process of identifying a solid trading opportunity. But we've got the situation here where it's moved above 80. We're in a downtrend. The market's below the moving average. We've got another situation here where we see the same thing. And this one came up a little bit short, but you can see how close it was and kind of gives an indication of the strength of the stochastic oscillator. One of my personal favorites, whether you use the fast stochastics, which I wouldn't recommend. Remember, we're trying to slow it down, or just the stochastics or the slow stochastics. That is a matter of personal preference. And as a matter of fact, on the stochastics, 14 means the number of days or number of periods we're using to compute, and that is the close relative to the trading session. The 3 is the 3-period moving average of the 14, and the second 3 is the 3-period moving average of the 3-period moving average. So we're just, again, moving averages. Without moving averages, none of these indicators would be available. And so it all really started with that. But we're going to look at some live examples as we go through this. I want to make sure that we can have a chance to look at the charts real quickly. Here's one of the newer ones, the CCI, really the same thing, developed by Donald Lampert in 1980, which means it's a baby compared to the others. And it really shows the same thing. We've got a situation to where we're not really measuring overbought and oversold, but you can see that when the market really moves up, strongly above the rest of the readings, you can see how it identified that counter trend move against the direction of the trend. Okay, and here's an example here, and a secondary one at the same time. Okay, and I know a lot of traders like the CCI, and they do use it. As a matter of fact, if you had done anything with the E-mini S&P over the last decade, you would recognize that there was a trading room by a gentleman by the name of Woody, and he was big on using the CCI in the direction of the trend. And you can still probably Google Woody's CCI and find some information on that. Very, very popular indicator, very good. The Parabolic SAR. Now we're getting to a little bit different where we use some indicators that can help us with our stop placement. Now the SAR stands for stop and reverse. I can tell you that there are many, many other, there's an abbreviation for many, many other terms, which I cannot repeat on this webinar, because stop and reverse to me is one of the most dangerous ways of trading. It's really an excellent way to have 2, 3 losing trades, one right after another really quickly before you realize what happened. Because trends don't change that quickly. From my point of view, we're either looking for buys or we're looking for sells, depending on the strongest trending markets that we can identify, which I will go over in more detail here in high probability breakout trading later on today. But if you put the SAR on here, you can see to where it does show moves against the direction of the trend and potential ABC moves. Okay, so it can become very valuable there. I would not use it for stop and reverse, because remember, we are only looking for sells in this market environment because the market is trending strongly to the downside. But you can tell that once those dots start printing below the market and they print above, that usually is a pretty good situation to look for, to potentially enter into a selling opportunity. So another way, something to look at there to play with a little bit on that SAR. But please, I do recommend, of course you can do whatever you want. That's the beauty. That is actually the best thing and the worst thing about the financial markets. You can do whatever you want. But I do not recommend you use it as a stop and reverse. Stop and reverse means that when you get stopped out of your buy, you automatically open a sell. And then when you get stopped out of your sell, you automatically open a buy. Okay, I like to stick with one or the other depending on the direction of that trend. Now we've got the average true range, another Wells Wilder favorite. And this basically just counts the number of pips or the move of a particular session. If it's a daily chart, it's going to tell us the average number of pips of movement per day on that market. If it's a 4-hour chart, it's going to show us the average number of pips movement in a 4-hour time frame. Okay. Now, this tool, the reason I talk about this, the value of trading can be somewhat limited, but if you get into a technical or otherwise get into coded trading at all, you will find that the ATR is really priceless for identifying initial stop placement for a lot of code. You'll see that the initial stop is 2 ATR or 3 ATR, meaning that if the market in a 4-hour period, moves, say, an average of 50 pips, they're trading on a 4-hour chart and they do their stop placement at a 2 ATR, that means that they're using an initial protective stop of 100 pips. Okay, so that is the value of the ATR, is to kind of give you an idea of how far your stop should be. Now what we're going to do, and later on I'm going to show you the ABC, we're just going to use point C as our potential stop. But if you're not using that approach to trading, the ATR can be a very valuable tool to give you an idea, because you're going to look at, say, the Aussie CAD, and it's going to have a 25 pip ATR. Then you're going to look at the pound yen, and it's going to be a 75 pip ATR. Well, it really makes a lot of sense to have a bigger stop on the pound yen, and because it is known as the world beater, and it can jump around dramatically, and you've got to give it some room to breathe, so you need a little bit more room on that initial protective stop. The ATR is an excellent way to kind of compare the different currency pairs to get an idea of the typical volatility in a time frame that you're using on the chart itself. Okay, so it can be very, very valuable that way. Okay, first of all, that's not what I wanted to say. That is coming up, but I wanted to go to the charts here. And let's start with the 4-hour chart. This is a 4-hour chart of the Kiwi yen. Okay, and again, you can see where I've got my 100 period simple moving average on there, and you can see a couple of examples here of where the market, the stochastics, I'm using a 14, 3, and 3 here, where the stochastics move below 20, looking for a buying opportunity, and you can see the market moved about 200 pips from the low to the high there. Now the main reason I'm using it here is because we see a situation here where the market is right now below the 20 level on the stochastics, and the market is still trading above the 100 period simple moving average. Let me get the crosshairs out of the way so it's a little bit easier to see. But this is an example. Now some traders will just look for the crossover. Now here's the key. When you're trading the crossovers, you've got to wait until this 4-hour period closes. You want confirmation that the crossover actually took place. You can see it is right now, but that doesn't mean that when this 4-hour bar or candle closes that the crossover is still going to be intact. We have to wait for the actual close. We want to wait for that crossover to actually be confirmed at the end of the time period, not during the time period. Because if we sit here and watch, particularly if we get on the shorter time frames, you'll see the stochastic, those two lines will cross over and then straighten out, then cross over and straighten out. You don't want to get caught up into that. Will it cross over? Will it not? Will it cross over? We want to wait until the end of that time period. If you're using a daily chart, then you want to wait till the end of the day's session to actually see that the crossover did close and actually took place. And then we open up our trade at the beginning of the next session. The same thing on a 4-hour chart. We want to wait for the end of this 4-hour period to actually close so that crossover actually can be confirmed to have taken place. Okay, here's the MACD. This is the pound dollar. Again, I have my 100 period simple moving average to kind of show the trend, and we can see these as that MAC dipped below zero. Here the crossover actually took place below zero, which is really what I like to see, if I'm using this for an entry. But you can see how it kind of took place after, well after, as a matter of fact, about a week after the crossover. That's not always a bad thing though, okay? And that just means that we waited for confirmation, and we can see we had some follow through to the upside. Again, another situation here where the market, the MAC crossed over below the zero line, and this is the zero line here, which is showing the histogram, which is just another graphic representation of the space between the two lines, the two moving averages. But you can see the crossover took place below zero for a buy as the market is trading above the 100-day simple moving average. This is the kind of thing we wait for to line up to get into trading opportunities. And another reason I took this one is we can see that the crossover did indeed take place and probably would have opened up a sell about 3 or 4 days ago, because this is a daily chart, but you can see how it can show the MAC crossover is taking place above the zero line as the market is trading below the 100 period simple moving average, and we can see a nice strong downtrend, and we can see a series of ABC moves, moving to the downside. So this is another example of how the oscillators, but really, I can't emphasize enough that the first thing I'm doing is I'm identifying markets that are trending strongly in one direction or the other. That really is what sets everything up. It's, the indicators really have no predictive value, zero predictive value. The only thing they can show is changing momentum. But if we've got a strong downtrend, we've got to move against the trend, and then we see changing momentum, that offers a little bit more value. That is using these tools the way they were meant, they were designed to be used. you know, and if you've tried using some of these indicators as the first thing you look at when you look for trading opportunities and try to develop an approach to trading based on that, usually, you know, you'll be disappointed because it's it's just not effective in that sense. That is not really what they were designed to do. They were designed to show changing momentum. Changing momentum doesn't really mean a whole lot unless you just find, you know, in its proper form. Then it can mean a lot more, obviously, and that's what we're looking for. And is it guaranteed? Now, you know the old line about guarantees. In the field of speculation, there's only one guarantee. If you trade, you will have losing trades. Everything else is negotiable. You know, but we want to make sure that we use strong money management to help us so we can absorb those losing trades, because that's what professional traders do. We have to learn how to lose gracefully before we can be a winner. I know it's backwards. You have to learn how to lose before you can learn how to win, but that is why many traders really never move to the next level, because they just can't get past the fact that a losing trade is okay. I will never say you have to like it, but you have to accept it. Okay, and by beating yourself up because you had a losing trade, it is not conducive to a long-term trading career. You don't, you know, the old line is don't get too high after your wins. You're not that brilliant, but don't get too low after your losses. You know. And let me see, we got a 15-minute chart, and we can see that we've got the crossover. My preference is to wait for that market to move down below the 80 line. As you can see this example here, where the move below, and it really showed a nice selling opportunity. But again, it's the same thing. We've got a market that's moving down. We can see the ABC pattern. It's below the 100 period moving average. And the reason I chose this again is because we can see here to where, you know, it is setting the same up. It is setting up again. Now, did it happen on the initial crossover? No, it did not. Okay, you know, these tools are not perfect. This is not a perfect sense. One of the reasons why I like to wait for that market to move below 20, just to make sure I'm catching this kind of a top or that kind of a bottom. Here's an example of a bottom to where the market has moved below the 20 period, or excuse me, the 20 value on the stochastics, while the market is trading up. Okay, the market is above the 100 period moving average, and we had the opposite. And here's another one here, and obviously a little bit short-changed here on that move. As you know, these kind of candles tell me that this was a news event that changed the direction of the trend. And by the way, that's going to be an important point, and you know, and I think Gregory is going to talk about that here in a minute. That the tops and the bottoms in these markets really are determined by the fundamentals. Otherwise, the news releases and, you know, the interest rate environment and so on and so forth. But how we get between the top and the bottom is really where technical analysis comes in. Okay, so just because that we caught a good technical setup and we went ahead and bought, that the fact that a news event can come out at any time and really change the direction of the trend. Now, granted, this is a 15-minute chart, but if you're trading on a 15-minute chart, this move is as big as if you're trading on a, you know, on a daily chart and see the same kind of candles. But we want to keep that in mind, and that's something that Greg is going to be talking about here going forward. But keep an eye on this one as we're going to see the market move down. A lot of things that I like to do here, either wait for the market to move below the 80, and we have to wait for that 15-minute candle to close to confirm it, or place a little sell stop here below the low of this pair, you know, right here, as another way of looking for confirmation that the market is moving to the downside, and then placing my protective stop above the high of this series of candles here. Okay, I want to thank you very much. I understand that was pretty quick. We had a lot of information to cover there, and I hope you found that of value. And I also want to say, you know, to remind you to stick around, because in about 15 minutes, Greg McLeod will be back. He'll be talking about trading around news announcements. Boy, that's a key word too. And we're not trading through them. We're not standing of them, watching them come at us. We are trading around them. He will be back up in 15 minutes. And thank you very much. And also to keep in mind that at the close of today's session, that $500 account raffle, and also for those of you that offer some feedback, is, we've got that $50 account. Again, we talk about when you're, I use 14, 3, and 3 for stochastics, and for the MACD, I just used the default setting of 12, 26, and 9 to answer your question there. Thank you very much. And we talk about using a demo account to become familiar with the software, but real money on the line to really learn how to trade, because it's the emotions that really are the big part of the a determining factor of your success or failure as a trader. And a $50 account, even if it's $1, boy, it's a big difference in just having a demo on there. Other than that, thank you very much. I will be back here in a couple of hours. We're going to talk about high probability trading. We're going to get back into, yes, 12, 26, and 9 for the MACD, and 14, 3, and 3. That's it for stochastics. Thank you very much, and everybody can see. Those are my preferred values. Okay, we will catch you.